Welcome to this month's edition of NFP Insights. Today I've got my good friend Emma Crocker from our mortgage team here at NFP.
Hello, thank you for having me.
How's life treating you, Emma?
Busy?
I can imagine. Mortgages, every time I turn the news on, they're all on the telly, the news, everywhere. So I thought it'd be really good for our viewers today to kind of hear from you what's going on. We're going to cover off things for first-time buyers. We're going to look at people that are remortgaging. Let's start right at the beginning then.
Okay.
Can you give us a bit of an update on the UK mortgage market at the moment? What's happened so far and why are rates where they are?
Okay. So we've gone through a period over the last 14 years of historically low interest rates. Then we had September 2022. The Bank of England decided to put its base rate up, and it's had a bit of a knock-on effect with lending. So the Bank of England put its rate up because external things have impacted the cost of living. We've all seen the price of gas and electricity going up following the war in Ukraine. It's meant that oil prices have gone up. We saw the cost of fuel, petrol and diesel going up. Supermarkets, shopping has gone up as well.
Pretty much everything.
Everything has gone up. And the way that the government control that, they put the Bank of England's base rate up, and it's just basically to try and slow down spending a little bit. The knock-on effect of that is that the Bank of England then decided, the lenders decided to put their rates up. That's meant it's costing more to borrow money.
Yep.
Now, over a series of the last few months, interest rates have continued to rise and the cost of borrowing money has also gone up. And it's meant for people looking to borrow money on a mortgage that what would have been perhaps more affordable has become more expensive to borrow money. And I'm typically seeing people having to find an extra £300, £400, £500 per month to cover their mortgage payment. Now, whether this will continue, I've no idea. There has been talk that the Bank of England might put its rates up again. When they do, and if they do, and by how much they do, is all down to the Bank of England. Whether that continues and then rent rates start to come down again, well, there is speculation at the moment that the Bank of England's rate might start to come down towards the end of the year. And if that happens, it means that potentially lending rates will come down as well.
Yeah, you've answered my next question there, so I won't ask you that one. But I was going to ask you what the outlook for the UK mortgage market is, I suppose, to the back end of 2023 going into 2024. Is there anything else you want to say?
Potentially, lenders have forecasted that prices of property might come down as well. Back end of 22, lenders were predicting that property prices were going to reduce by between 5 and 12%. Now, if you take an average of around 8%, that gives you a general idea, but I really think it's more regional rather than a national average. So if that happens, that might mean that buying a property becomes more affordable. If that, alongside with mortgage rates coming down together, it might mean that property purchases become more affordable all in all, plus refinancing property. So it's not just buying, it's about what you've got owned as well.
Yeah, brilliant. So when you're delivering a lot of these, I know you go out to see a lot of our clients and you're obviously speaking to a lot of people internally. What's the most common question you're getting asked at the moment?
Should I fix or should I go on to a variable mortgage rate? Yeah. That's probably the most popular question. And I think the answer to that is really down to the individual and how they feel about their own finances. So if you're somebody who is quite keen to be able to budget, to know exactly what you've got going out of your bank account each month, then fixing your mortgage is absolutely going to be the right thing for you. Taking a rate that's going to move up and down, it isn't going to sit well. Whereas if you're somebody who thinks actually there might be a little bit of room here where interest rates could go down, I understand there's a little bit of a risk that interest rates could also go up. then maybe going on to a variable rate might be the right option for somebody. But it's down to individual choice.
And how long are people typically fixing for?
So it really depends again on the individual. Traditionally, the shorter term fixed rates were better value for money.
Yep.
That the shorter term fixed rates were cheaper to borrow money. As it stands at the moment, if you took a 5 or a 10-year fixed rate, you'll be offered better terms than if you potentially took a 2 or a 3-year product. But it goes back down to what's right for the individual.
Personal circumstances.
Yes.
Yeah. And I suppose people can be quite short-sighted. I suppose this is a property's a long-term.
You don't buy a property thinking you're going to sell it within a couple of months.
Yep.
You buy a property with the intention of potentially staying there years.
Yep.
It might be 2 or 3 years, but it might be 10 or 20 years. So when you're looking at financing a property, you've got to think about the long-term goal here, not just the short-term. And so sometimes people will talk to me about taking a short-term fixed rate because they don't want to be tied in for something for very long. They want flexibility. And then those people are coming back to me not that long ago, having seen them, and they're saying, Emma, we wish we'd listened to you because we could have secured a better rate a couple of years ago for longer, and we're in a position now where we've lost out. I suppose, again, it's down to the individual, but it's a minefield, but it's understanding and getting to know the individual about what's right for them.
Yeah, and right for them at the right time.
Yeah.
So, just leading on to my next question. So for people that are fixed.
Yes.
And say if they're on a five-year fix at the moment and they're 2 years out, a year out, is there an ideal time when they should start looking at or speaking to a mortgage advisor about when when to start the work on looking at the next rate that they're going to secure?
So I'm having people contact me during their current fixed rate deal. So I don't know, a couple of years before their current deal.
Really, that far out?
There are people talking to me, and there are situations where people are choosing to pay an early exit penalty so that they can secure a rate now before rates continue to rise any further. That said, the ideal time typically to start looking at a remortgage is 6 to 7 months before the current deal expires. It gives you an opportunity to really look at the mortgage options that you have.
Yep.
It's giving you an opportunity to sort out if there are any things we need to sort, like changing addresses, like getting pay slips organised, paying off a little bit of debt, anything like that.
Yep.
It gives you a chance to get those bits organised. But it also, and the most important thing, it gives you the opportunity to secure a rate up to 6 months before your deal finishes. So if interest rates continue to rise, it means that you can secure a rate 6 months early.
Yeah.
If they come down, there's no reason why we can't sit down and have a look at that mortgage rate again nearer to the expiry of your current deal, but it gives you the best of both.
Yeah. And if you're not using a mortgage broker, typically is your kind of your lender just writing out to you on a piece of paper saying your rate's ending, we're gonna switch you over onto this rate, or have I got that wrong?
Normally a lender will contact you around 3 months before your deal's due to end, inviting you to have a look at their own product range.
But only their products.
Absolutely. Yeah. And it's not always the right thing to do. So going to your existing lender absolutely is a good place to start, because it's good to see what they're offering, but they're not going to tell you that the next lender is actually potentially offering you a better setup.
So that's there's one value of using a mortgage broker.
Absolutely. The other thing is that by using a broker, we often get better mortgage rates than you would be offered by approaching your lender directly.
And why is that? Is that just economies of scale or trusted relationships?
No, so approximately 75 to 80% of a lender's mortgage business is submitted through a broker.
Right.
So we're doing the lender's job for them. We're checking your affordability. We're checking criteria. We're checking that it meets the lender's lending proposition before we actually get it submitted. And because we're doing all of that first, the lender, when they get the application, it's tick,
It's all done.
Absolutely. And because of that, they're able to give brokers better interest rates as a way of saying almost thank you for giving them the mortgage.
And how much work is involved in doing that exploratory work on interest rates?
Well, right now it's a massive job. Don't ever underestimate how much work is involved in organising a mortgage. We have to check that it's affordable, given what's happened with the cost of living. What might have been affordable previously might not be affordable now. So things like the cost of gas and electric is filtered through to the Office of National Statistics. That data is then pulled through into a lender's affordability calculation. So whereas a lender might have offered you X amount 6 months ago, now they might be saying, well, actually, we're only going to offer you this much because we recognise that you've still got to pay for all these other bits and pieces in relation to running this property. So checking affordability is key. Then checking the lender's criteria to make sure that you meet that lender's criteria. And then, of course, checking rates. So it's not always looking at the interest rate that a lender's offering. It's checking all the other bits that go alongside with it. Now, these lenders are changing rates and criteria all the while. It's a sliding scale all the time. And so I use the analogy that you're a little bit like a jigsaw puzzle. When I first start talking to a person, I don't really know what we're going to be doing for them until I start putting a few pieces together. Once I start putting a few pieces together, the picture becomes clearer, and I know what we're going to end up with, and I know what the picture's going to look like.
When you run your analysis on your computer and it comes up with the rates, how many lenders are on that screen?
I have access to approximately 120 lenders.
So that's something that just literally, someone like me, I can't really do that on my own unless I've got loads of time and I know exactly what I'm looking for.
Yeah. So I'm looking at lending from almost a bird's eye view. Whereas you going to talk to a lender individually, well, lender A is going to spend an hour with you and do this, and lender B is going to spend another hour with you and do it slightly differently. Lender C, and so it continues. Whereas I'm looking at one set of data and I'm looking at all the lending criteria and saying, actually, Mr. Customer, based on what you've told me, I think lender X is going to be the best one for you. And that's down to my experience and the wealth of knowledge that I've gained over the years that I've been working as a mortgage advisor.
Fantastic. I like that answer. Really good. Remortgaging. Right. Yes. So people with a mortgage that are coming, looking at switching or moving house, they're coming to the end of their term. When should they start looking at reviewing their options, and how can you help them?
So remortgaging, I'd say 6 months before, 6 to 7 months before. Somebody moving house, they can move house anytime. So if somebody's partway through a mortgage product and they're looking to move house, we can do something called porting. So it means we take the existing mortgage with you from where you're living to your new property. Now, if at the time that you're looking to borrow a little more money to be able to purchase your new property, that's potentially available. We look at all the options and decide whether sticking with your existing lender is going to be the right proposition.
So that's borrowing money with your current lender, just attaching it to the current mortgage.
And so you end up with two mortgage accounts. You'll end up with a chunk that you're pulling across from your original mortgage, and then you'll end up with a second mortgage account that's for the top up that you're going to need.
Even with the same lender?
With the same lender, but it won't necessarily be on the same rate.
And would that money leave your account at the same time?
It could do if that's what you wanted it to do. Right. Typically, most lenders will set the same direct debit date up. Some lenders take them as two separate payments. Some lenders wrap it all into one big payment. It really just depends on the lender.
And could you have a mortgage with one lender on your current property, and the house you move into, you get?
Not as a traditional mortgage, you don't. As a traditional mortgage, it's all to do with how the charge is registered on a property, and most mortgage lenders want to have first charge on the property ownership. So in the event of a repossession, it means that that bank wants to be the first people paid back once the house sale goes
One
through.
bank as opposed to two lenders, which I was
Yes.
just assuming there.
Yes.
For people that have rates reserved, because I know in the intro we talked about that kind of 6-month period where you can reserve a rate. What happens if the interest rate goes up or goes down in that 6-month period?
So in that 6-month period, if interest rates go up, well, you can be, have peace of mind knowing that you've managed to secure
got a good rate
and you're okay. If interest rates go down, there's no reason why we can't sit down and have another look at that mortgage just to make sure that you are still on the right deal.
Yeah.
And in fact, over the last couple of weeks, actually, there have been a few lenders that have actually reduced their rates, that have put us in a position that we've been able to give the customer who's had a mortgage offer issued actually better terms with that same lender. Yeah. So we've been able to change that interest rate and mean we can save that client some money. And yesterday, I only managed to save somebody £96 per month over a 5-year deal.
It
so
all
you
adds
imagine.
up.
Yes.
Yeah. And that 6-month window, that's standard across the industry.
Yes.
Yeah, 6 months.
Yes.
Fantastic. Well, is there anything else that we should be talking about today? You speak to people on a daily basis about their mortgage situation. Is there anything else that I've missed? I know I've got a series of questions.
I think people need to be aware that they need to be mindful of debt that they've got. So
what counts as debt? What are you talking about there? Like
car finance, personal loans, student loans. It could be a mobile phone on contract. It could be a credit card debt, catalogue debt. All of these are taken into consideration on a lender's affordability. So if you have any of those in place, it doesn't mean to say that you can't have a mortgage, but it will affect the amount that you can borrow. So if you have the opportunity of being able to clear any of those things, it might mean that you can borrow more money. Equally, those people with financial commitments such as childcare costs, they're also factored into affordability, and that can have a detrimental effect on how much you're able to borrow. So whilst people having families and having childcare costs, it's a fact of life. People will have those commitments.
Just stop that.
You can't just stop them. We just need to bear those in mind as well when we're looking for a mortgage. The other thing to mention is things like bank statements. Make sure that you've got the correct address registered on them. Because we're all using internet banking these days, so many people forget to update their bank details with their up-to-date address. And one of the things that banks and building societies will be doing is looking at your credit history. And they'll want to know if you've got a bank account registered at the wrong address, why. So just make sure everything's up to date. So bank statements, pay slips, credit card statements.
And how far back are you going? Is it like 3 months worth of statements, 6 months?
Typically, a lender will ask for 3 months, but they can ask for far more than that if they want to. So usually it is a 3-month window that they're reviewing. But if there are situations where they might want to look a little bit further back, and if that's the case, we need to make sure that you've got the correct address on your account at that point. So if you are looking at moving house or you have moved house, just make sure that everything is up to date.
Yeah, brilliant. I think that's it. Emma.
Bingo.
Absolutely fantastic. So if we have got any viewers on today's Insights piece and they want to get in touch with you, what would you prefer them to email mortgages@nfp.co.uk, or would you want them to email you direct?
That email address is absolutely fine. Yeah,
fantastic.
Absolutely fine.
Yeah, that's really good. Well, hope you enjoyed this. It's been really useful. I mean, I've learned loads. I hope you have too. If you do want to find out more about our mortgage proposition, visit the nfp.co.uk website. You'll see the mortgage tab. It's in our wealth section. So hope you enjoyed it. Thank you very much.
Thank you.